Okay, in our last session, we ended up with qualified retirement plans, and we're going to look at 401ks. Just spoke briefly about 401ks, so I want to pick up there and begin to look at page 3-21, limitations on contributions to and benefits from a qualified plan. So limitations on the contributions that I may make to the plan, and then benefits from a qualified plan. Okay, so we want to pick up there and begin to look at that. As I mentioned at the end of the last session, that there was two plans. We have, or two ways we want to look at it. We have what we call defined contribution plans, okay, so we have defined contribution plans, and then we have defined benefit plans. Okay, so those are the two we're going to look at. Okay, at the bottom of page 320, I'm going to read this example and then we will go back to the notes. Heather is an employee who earned $30,000 during the current year. So she's an employee who earned $30,000 during the year. Her employer contributed $1,200 or 4% of Heather's salary to a qualified retirement plan. This plan is a defined contribution plan. Okay, so back to our note, defined contribution plan. Contributions not to exceed the lesser of $46,000 or 25% of the employee's compensation. Okay. So now let's look at the top of page 3-21. Alan works for an employer whose qualified retirement plan states that Alan will receive a retirement benefit at age 65 equal to 40% of his last year's salary. The employer must make adequate contributions to the plan to enable the stated retirement benefit to be paid, meaning they need to make sure they put in enough, make sure it's sufficient amount so that when Alan retires, he will be able to receive 40% of his last year's salary. Okay, this plan is the defined benefit plan. So when we go to our notes, benefit, okay, the benefit payable amount, meaning the amount that they will benefit, is going to be limited to the lesser of $185,000 or 100% of the average compensation for the highest three years of employment. Okay, so as you can see, there's limitations on those contributions. It doesn't matter if you're involved in a defined contribution plan where they place a limit on the contributions that's going in, or if you are a participate in a defined benefit plan where they're going to place a limitation on the benefits. So defined contribution, they're going to limit your contributions to $46,000 or 25% of the employee's salary. For a defined benefit plan, they're going to put a limit on the benefits, and those benefits being the lesser of $185,000 or 100% of the average compensation for the highest 3 years of employment. So just be aware of that. Then our 401k plans, basically contributions to 401ks. to those, they are made pre-tax. So the income that you put into your 401k is going to be made before it's taxed. Okay. And so as far as the limitation goes on that, it's going to be limited to 15,500 of the salary, or if you are 50 or over, so 50 plus, it's 20,500. Okay. And so it's normally a percentage of your salary. You say, I want to contribute 15% of my salary, but the situation is whatever that percentage is, that amount cannot be more than 15,500 per year, or 20,500 if you're 50 or over. So if you look on page 3-21, we have an example there. Let's look at that example. Carol is age 48, participates in a 401k plan. Carol's salary is $30,000 per year, and she chooses to contribute 15% to the 401k plan. The maximum amount she may contribute on a tax-deferred basis for a 401 plan under her salary reduction agreement is $4,500. In that case, it was 15% of her $30,000, which was $4,500. Now, whatever her percentage, she could have did 50% of her salary, which would have been $15,000. That still would have been okay. She could have did, but she couldn't have done a percentage that would have caused her amount to exceed $15,500. So it couldn't exceed the $15,500. Now keep in mind there's going to be a penalty. Contributions in excess of the maximum allowed amount is subject to a 10% excise tax. So contributions in excess of that limit is going to be subject to a 10% excise tax. Okay, and that's going to be imposed on the employer. So just be aware that there is a limitation on that. Next, we want to look at low income retirement plan contribution credit, which is a saver's credit. They have this credit out there that you can get if you are low income and you are contributing to a retirement plan. So that's basically what they, it's a saver's credit. And that credit is going to be based on the taxpayer's filing status, okay, AGI. So it's based on the filing status and the AGI, and the credit is anywhere between, you can get a 50% credit, it may be a 20% credit, or a 10% credit of the contribution. Okay, and if we look at page 322, they give you more details of coming up with that credit, but just be aware that that credit, it could be anywhere 50, 20, or 10% of the contribution. It can be any of those, 50, 20, or 10% of the contribution. Okay, we want to look at rollovers. On page 322, we're going to look at rollovers. How do we deal with rollovers? What if I want to take, my plan and my money in one plan and put it over into another plan? It's still, it's still an IRA. It still meets those qualifications. I don't want to take it out. I just want to take it from one plan to put it in another plan. Okay? And those are rollovers. Those are rollovers. We have two types of rollovers we want to look at. We want to look at a direct transfer. Okay, so we want to look at a direct transfer, and then we want to look at a distribution rollover. Okay, so we want to look at those two rollovers. We want to look at a distribution rollover and a direct transfer rollover. Okay, so I want to kind of just show it to you visually, because I'm a visual person, And so what we want to do is, let's say that I have my money in an ABC 401k. Maybe it's in an IRA, and maybe it's in some type of retirement plan. Okay? And so then what I do is directly have it placed into CDE 401k, IRA, or some type of retirement plan. In doing this, if I do it this way, there's no penalty. And there's no tax. Yep. And that's the preferred way to do it. There's no penalty. There's no tax. It goes from one plan to the other. I never see it. I fill out the necessary papers for it, but it's direct. It goes just directly from one to the other. Directly from one to the other. Okay? So now we want to look at a distribution rollover. We want to look at a distribution rollover. In this case, I have my money in ABC, 401k, IRA, or whatever the case may be. Then I have them distributed to me. Then I turn around and put it in C, D, and E, 401k, IRA, or whatever. Okay? So in that case, there's a situation. First of all, when ABC gives it to me, they're required to withhold 20% tax. 20% is going to be withheld. Okay? And then I'm going to have 60 days to get it into CDE. Now the difference is that when I got it, I only received 80%, because remember, they withheld 20%, and the IRS took 20% and they withheld it. And so, but then when I put it back into CD and E, I have to put the entire amount in there. Okay, so let's look at an example. Let's say that we have $100,000 in ABC. We have $100,000 in ABC, and they're going to take out $20,000, and so I'm only going to end up getting a check for $80,000. Okay, and then when I put the money in C, D, and E, I'm going to have to put $100,000 in. If I don't, if I only end up putting the 80 in, there's going to be a 10% penalty on an early withdrawal. There's going to be a 10% penalty on an early withdrawal if I don't put the full 80. So the issue with that is that I'm going to have to come back up with $20,000, because the IRS took $20,000, and I could very well get it back as long as there's no penalty when I file my tax return. So I've allowed the IRS to hold that $20,000, and I'm going to have to come up with another $20,000 to put back in my plan. I'm going to have to come up with another $20,000 to put in my plan. Okay, so be careful with rollovers. You know, you do have 60 days, but just keep in mind when they distribute it to you, there's going to be 20% that they're going to withhold for taxes. Even though you may not be penalized, you end up putting it back in 60 days, but just know you're going to have to make sure you put the whole amount back. And I think that sometimes people may not be aware of that. So that's why direct rollovers are so much better, because you don't ever have to worry about it. It's going to be a direct. Okay. The last little thing we want to look at as we finish up this chapter is we want to look at simple plans, savings incentive match plans for employees. Savings incentives match plans for employees. That's what that stands for. Okay. These are qualified plans. Okay, and there's for small businesses, and basically we're looking at where they have where they don't have more than employees, or not more than, I'm not stating this right, not more than 100. So let's say employers don't have more than 100 employees. That's the way I want to state it. And of those employees who earned $5,000 or more in the preceding tax year. Okay, so they briefly talk about these simple plans, and there's going to be some limitations on those contributions, none that we're going to really cover, but just be aware that they're called simple plans. They're out there, simple IRAs, and that is really for small companies or small business where you don't have more than 100 employees and who earn $55,000 or more in preceding tax years. So you want to look at that. Okay. Well, that's all we have in Chapter 3. That's all we have in Chapter 3. And so we dealt with rental, and we dealt with bad debts, and then we spent a lot of time on retirements and IRAs, Roth IRAs, SEP plans, KEG plans, and 401ks. Okay, so now we want to go over to Chapter 5. There may be later some specific things that I want to cover in Chapter 4, but for now I want to go on over to Chapter 5, which is Schedule A. Schedule A deductions. Schedule A deductions are like your medical deductions, your charitable contributions are Schedule A, and so those are those ones that appear on that. Let's look at a Schedule A real briefly before we get started. Okay, we want to look at the Schedule A. It starts off with medical. We have medical and dental expenses that are on the Schedule A. And let me get a little better Schedule A. I kind of tore where you can see that. We start off with medical and dental expenses, and then taxes that you paid. So we're going to look at taxes. And then interest is the next section that's covered on Schedule A. And then we look at charity gifts, or your charitable contributions. And then our casualty and theft losses are covered on Schedule A. And then we have miscellaneous expenses, which are going to be job expenses and certain other, like safe deposit box, tax preparation fees. And then we have a section for other miscellaneous deductions. And then we get our total. Now keep in mind here at the bottom, they talk about if your line 38, which is your AGI, is more than $159,000 if you are single, head of household. If you're married, filing separate, it's $79,975. And what that means is that you could be limited to some of your Schedule A. You may not get them all. You're going to be limited to some of them. So we'll do that calculation. We have that calculation still to do. And then remember, if you're a high income taxpayer, you very well could be limited on some of your exemptions. You may not get your full exemption amounts as well. So just keep that in mind. A limitation also applies there. Okay, let's go ahead. You should have a handout like this that you got in your packet of information. And as we go through, similar to what we did in the last chapter, we will fill out and go through the notes. We start off with our medical expenses. When we're talking about the medical expenses that you can take, these are the ones that are paid for yourself, your spouse, and then any of your dependents. Okay? And so for your spouse, yourself, or any of your dependents. Now, the thing about these is that there's a limit on them. They're going to be limited to 7.5% of your AGI. Okay, so you're going to have an AGI limitation on. I mean, I'm not going to get them all. I'm only going to get the amount that exceeds 7.5%. I'm only going to get the amount that exceeds 7.5%. So this is the way the calculation goes. We have our qualified medical expenses, all those that qualify, and we're going to look at those that qualify. And then we're going to subtract from that any insurance reimbursement. So if we have all these expenses and we have insurance, we could very well have some insurance reimbursement that applies to those. And that's going to give us just a subtotal of our potential deductible ones. And then we're going to subtract from that 7.5% of your AGI. So you're going to take your adjusted gross income, multiply it times 7.5%, then you subtract that from your subtotal, and then any excess is going to equal your deductible medical. It's going to equal your deductible expenses. Okay? Basically, that's your calculation. When we look at qualifying expenses, and the way they state it, they say anything, and then we'll look at anything, but basically items that account for the diagnosis, meaning I'm going to go get checked out, and then the cure, mitigation, treatment, and any prevention of disease. Okay, and those items appear mainly on 5.2 when we begin to look at them. 5.2. Okay, and so they start with at the bottom of 5-1, and we go over to 5.2 on some expenses and things like that. So just know they look at items for, whatever, we're trying to cure, we're trying to treat, we're trying to prevent, or whatever the case may be. At the top of page 5-2, basically, therefore, amounts for all the following categories of expenditures qualify as medical. So prescription medicine fees for doctors, dentists, nurses, prescriptions for hospital fees, hearing aids, dentures, psychiatric care, acupuncture, birth control prescriptions, medical insurance premiums, if I'm making those payments, all those things are considered. Also, would you believe in that little section, the IRS allowed the following unusual medical expenses: long distance phone calls made to a psychological counselor, new siding replacing old siding on a home because the taxpayer was allergic to mold growing on the old siding, a wig prescribed by a psychiatrist for a taxpayer upset by her hair loss, a cell phone for a taxpayer who may need instantaneously medical help, and then treatments provided by an Indian medicine man. Those were some particular ones that the IRS in the past has allowed. Okay, so let's look and keep going on at the bottom of page 5-2. We look at medical insurance. We want to look at medical insurance. Basically, policies. When we're looking at medical insurance, we're looking at policies that pay a specific amount each day or week is not going to be deductible. So if you have a policy, all the other ones are okay. But if you happen to have a policy that's specific to each day or week, then it's not going to be considered. Okay? Basically, medicine and drugs, what we're not going to be allowed are over the counter, and illegal drugs are illegally purchased. Okay, so if we're purchasing drugs from somewhere else, we're not going to be able to deduct those. If we're purchasing them from across, from Canada or wherever, I think the popular place now is to get drugs. Now, what if I have to get something done to my house? What if, I can no longer walk up steps and I have to get a elevator put in my house? Or what if there's just something major, a capital expenditure that I need to have done? Now, I can deduct these capital expenditures that I need are deductible to the extent the cost of me putting that in, the cost exceeds the increase in the value of my home. So there's got to be an increase in the value of the home, and that cost has to exceed that. So let's look at an exercise or an example on page 5-3. A taxpayer has a heart condition and installs an elevator in his home at a cost of $6,000. So that's the cost of the elevator. The value of the home is increased by $4,000 as a result of the improvement. The taxpayer is allowed a deduction of $2,000. So we want to take the $6,000 cost of it minus the increase in value of $4,000. So the $2,000 would be a deduction. $2,000 would be a deduction. Okay, next is transportation and lodging. If you have to travel, distances for treatment, if you have to maybe stay at a hotel, the transportation, you can deduct 19 cents a mile for that. And the lodging is going to be $50 per night, despite what you pay, but this is what you can deduct, $50 per night per person. $50 per night per person. And I want to say they are going to limit you to 2 people. So you got 19 cents per mile. And then the thing about it is this is a year, as we go over our other miles, we have a split year of miles. Every now and then we run into, when we're dealing with mileage, for charitable contributions, which we'll deal with later in this chapter, when we're dealing with mileage for employee business expenses. So every now and then we'll run into a year where we have 2 different amounts. So it's 19 cents a mile, okay? And that is from January to July. So from January to July, it's 19 cents a mile. And then 27 cents, and actually we want to say till June because the 27 cents starts on July 1st. 27 cents from July to December. So basically for 6 months, and depends on when you travel, for 6 months, it's 19 cents for January to June for the first half of the year, and then 27 cents for the last half of the year. And we'll run into that exact same thing when we deal with, you have the ability to take mileage for charitable contributions. So just be aware that the mileage is split. So $50 per night for your lodging, no meals. So it's just the lodging that they're going to allow you. Okay. Let's keep going on our medical. Okay. And also, they mention, we don't have any notes on that, but on the back, on page 5-4, they mention health savings accounts, and know that those health savings accounts replace those medical savings accounts that used to be out there, and where you can take some tax deductible contributions to a medical spending account that can be used for when you have a high deductible medical insurance. There's some rules that apply to that. We won't cover those. Just be aware of that on page 5-4, the health savings account. Okay. Next, we want to move to taxes. We can deduct taxes on page 5-5. Okay, when we're looking at taxes that we can deduct, we're looking at income taxes or sales taxes. Okay, so it's either or. Either you're going to do the income taxes or you're going to take the sales tax option. Okay, when we're talking about income tax, we're talking about state and local taxes that are paid or withheld from your paycheck are deductible. I think I'm spelling that right today. Okay, so if, for instance, if you work in Kansas City, or if you live in Kansas City, they are going to withhold Missouri state taxes and Kansas City earnings tax. So in that case, you would have state and local taxes that are withheld from your paycheck. Okay, and so in that case, you can take a deduction for that on Schedule A in the year that they're paid. Or you can take this sales tax option and you can use a table that they offer, or you can take actual sales tax. That meaning that you would have to keep track of all your receipts and all that in order to get the actual sales tax. Other than that, you can take the actual or use a table. Okay, on page 5-6, for taxpayers electing to deduct sales tax in 2008, the deduction may be calculated by, as they say, either the actual or that sales tax table that they have. Plus, when you're using the sales tax table, you want to look at, specific separate sales tax that you paid on a vehicle, a boat, airplanes, or building materials, not appliances and things, as they say, because that won't be calculated into the table. The table is just going to consider your everyday normal things. So it may be an option for someone who has low income, so therefore they didn't have a lot of state and local taxes withheld for their income. But for some reason you buy a car, or there's a situation that made you have high sales tax. So in that instance, you're going to want to take the sales tax option instead of the state and local income tax option. So it's just an option that you have. It's an option you have. Okay, so we want to move on to property taxes, which is your real estate taxes. Okay, they're deductible on your home and a second home. So that's why we were talking about when you had that home that was that rental. How do I want to say that was a split? Then when we had that rental that was a rental split, then we could take that mortgage and interest personal portion of that mortgage taxes. Let me get my words right. Mortgage taxes and interest on Schedule A, because they tell us that when we take our personal property taxes or our real estate taxes, we can deduct taxes that's on our main home and a second home. So if I have rental property that's considered to be a rental personal split, then therefore that half that's personal can be treated as my second home, and therefore I can take it. Okay, I can take it. You can take that deduction on that even if it's paid through escrow. Some of us pay our real estate taxes through escrow. And so that'll come in on your statement when you get your year-end statement, and it'll be there. When you sell a home, be aware that there needs to be a split of taxes between the buyer and the seller. Between the buyer and the seller. So just be aware that there's a split. Personal property taxes that we can take. You can take separate personal property on autos, boats, trailers, things like that you have to pay a personal property tax on. Just as long as as long as it's based on property values. So in order for it to be deductible, it has to be based on the value. on property values. So make sure that is the case. So that is our taxes. The other thing that's not mentioned here is that you can also take, let's say, April 15th of 2008. I filed my state income tax return and I owed $500. So when I filed my 2007 tax return on April the 2008 and I paid that, those were taxes that I paid in 2008. So therefore, when I do my 2008 tax return, they're going to be deductible. So let's move on to interest. Interest is going to be deductible in the year that you pay it. And that's the same with taxes as well. They're going to be deductible in the year that it's paid. Okay? So we can take interest deduction on our residence, which is going to be mortgage. Okay? And so basically, once again, we'll get to do it on a second home, our main home, and then our second home as well. So you can take it on two homes. And it's going to be on the debt that you used to buy or secure your home or construct it. So maybe I built it. Okay. And that particular amount, those loans on the securing or construction of a home is going to be loans up to $1 million. So if you build $1.5 million house and you borrow it, you can only deduct the interest on up to $1 million of that home. So even though I got the $1 million home, $1.5 million home, the interest that I'm going to be able to deduct is going to be only up to $1 million. Home equity loans, as you know, they talk about home equity loans that we get. That interest is deductible as well, and it's deductible only on loans up to $100,000. Only on loans up to $100,000. And then they talk about points as well. Points are going to be deductible. And if it's the points through a refinancing, those particular points are going to have to be capitalized and amortized. So we can't deduct those if it's on a refinancing. Okay, so those are our interest on your home. So just be aware that there's a situation that if you have a very high or very expensive home, you may not get all of that. Let's look at an example regarding that. Vicky's residence, I'm on page 5-9. Vicky's residence has a fair market value of $300,000. The first mortgage used to buy the house 10 years ago, $125,000, so that meets the limitation. This year she borrows $115,000 on a second mortgage, so that's her home equity loan, secured by the house to send her children to college. The interest paid on the first mortgage is fully deductible, but interest on only $100,000 of the second mortgage is going to be deductible. And so what she's going to have to do is only take a portion of that. She's going to take $100,000, which is the allowed amount, divided by the $115,000, which is her loan amount, and then multiply it times the $7,000 worth of interest attributable to that. So in that case, she wouldn't get the full $7,000. Also, no consumer interest is allowed. So your interest that you have on auto loans, credit cards, all that particular interest is not allowed. You cannot deduct that. Okay. Next is on education loan. We pay interest on our education loans, and that interest, education loan, is deductible. That is deductible. It's deductible up to $2,500 per year. Now it's going to phase out for high income. It's going to be phased out for high income taxpayers. Okay, and so on this particular loan, education loan, it has to be a loan that was used for qualified expenses. And those qualified expenses are tuition, room and board, and then any other related education expenses. So any other related expenses. So keep in mind that there's a phase out, and on the top of page 510, they list our phase out amounts. For taxpayers who are single, their modified AGI $55,000 to $70,000, and for married taxpayers, a modified AGI of $115,000 to $145,000. So if you are within those ranges, it's going to be phased out. And if you exceed those ranges, you cannot get a deduction for that. You cannot get a deduction for that. Okay. So that's your education loan interest deduction that you can take. So I want to stop there. And what we need to do is you need to make sure you're reading through Chapter 5. And as you read through Chapter 5, begin to answer those questions. Like I said, these deals with the itemized deductions. And so next time we're going to pick up with the investment interest and look at that calculation. And we probably will get a chance to, I believe, to finish the chapter. So make sure that you read through Chapter 5 and look at Schedule A. We'll do a couple little exercises and problems for Schedule A. So we will stop there at education loan interest. And we finished Chapter 3, so I'm expecting some multiple choice questions shortly on that. And that's it.